So the question I get almost 100% of the time is, hey, what are your interest rates at Benchmark Mortgage? Well, the short answer is it's going to be different for every single borrower. There's a lot of lenders that will put stuff out online. There's banks that will post interest rates. All of those are simply numbers that will get you on the target, but they're not going to get you the bullseye being the rate that is specific for you. So today we're going to talk about something that is called risk factors, and those risk factors impact interest rates for every borrower. And every single borrower has a different set of risk factors. So the answer to the question, hey, what's your interest rate, isn't so much about the bank as it is about the borrower that's going to determine what that rate is. So let's kind of break this down, and hopefully it'll make the whole process of rate shopping a little bit easier for you. So when we're looking at interest rates, there's a base rate that everybody starts with. And that base rate is the interest rate that is determined by the secondary market, and that base rate changes constantly. So when we as a lender originate a mortgage loan, we don't have billions of dollars to lend out. We actually will originate a mortgage loan, and then we deliver that mortgage loan to the secondary market. The secondary market is where that base interest rate is being determined. They're saying we need a rate of X. And again, that changes constantly throughout the day. But what happens is years ago, and this is prior to 2007, 2008, years ago, everybody delivered different interest rates based upon what they felt was the right rate to deliver. Well, the problem is the secondary market couldn't tell whether a borrower was a good borrower, a bad borrower, an okay borrower. They just didn't know. So after 2008, when the world came crashing down, we call it D-Day in the industry, when that occurred, the federal government came out with these risk factors to level the playing field for banks and to make sure that a borrower, whether they went to Bank A or Bank Z, that they had to follow the same risk factors when they determined what their interest rate was. What was really, really important about that is that meant that the secondary market, when they purchased those loans, were getting loans that were all based on the same risk tolerances, regardless of the lender they came at. So what are those risk factors? Well, they're going to vary from every single borrower. And I'm going to tell you that there's about 30 to 35 different risk factors that every single bank has to look at. And every one of those risk factors will either help your rate a little bit or hurt your rate a little bit. Okay? So let's kind of talk about what those are. Well, the first one is pretty obvious. FHA loan, VA loan, or conventional loan is going to impact what your rates are. That's the first risk factor. From there, we go into the borrower. So we're going to look at things like your down payment. The more money you put down will help your interest rate a little bit. We're going to look at things like credit scores. That's a big one. It used to be that we would just say you have good credit or bad credit. We don't say that anymore. Now we look at things as specific as your credit score. And so what's crazy about this is that a credit score of 760 will get a little bit worse interest rate than a credit score of 780. And it's really a 20-point increment. So 780 to 760, 760 to 740, 740 to 720, and so on. And so a lot of times people will come in and say, well, my friend got interest rate X, and I'll say, well, what's their credit score? And I don't know. So, well, that's going to impact the interest rate that you get. So interest rate is one of those risk factors. Down payment is one of those risk factors. Loan amount is one of those risk factors. You look at things like appraisal. Where is the property located? Huge impact on risk factors. Is the property in Texas where you could have hurricanes tomorrow? Or is the property in up north where it could have, ice storms? There's all different things that will impact the interest rate that particular loan is looking at. We're also going to look at things like debt ratio. So if someone has a higher debt ratio, they could be paying a little bit higher rate than someone with a low debt ratio. We're going to look at where their money is coming from. That could impact the risk factor and the interest rate. So like I said, I don't want to go into all of them, but there's 30 to 35 different factors that we as lenders have to evaluate on every single borrower to determine the interest rate that you get. So, I'm going to make a funny analogy. When you go to a doctor, you want to make sure you know where the doctor went to school. You want to make sure you know what kind of degree the doctor got. You want to make sure you know the history that the doctor had, right? You don't just walk in and say, hey, you're going to operate on me. Hope you know what you're doing, right? Well, the same thing is true with mortgage lenders. When I'm looking at a loan for a borrower, I'm looking at all of the these different risk factors, and I'm trying to make sure that we prioritize the right one to get the borrower the best product that's out there. Super, super important. Let me give you an example of something that happened the other day. I had a client that called in and they said, hey, we're shopping interest rates. We've already got an interest rate of X. And I said, okay, great. Thanks so much. Let's talk about it, see where you're at. Well, we started analyzing the risk factors. And what was interesting is they were a client with a very, very high credit score, and they were putting 10% down. And the lender that they had talked with had told them that an FHA loan was a better loan because the risk factor on an FHA loan gives you better interest rates typically on an FHA loan versus a conventional loan, okay? And so they were super excited about this really low interest rate that they had gotten on an FHA loan. But they had great credit and they were putting 10% down. So I asked a question that I ask all the time. I said, let me ask you a question. Would you like me to give you a different point of view? And they said, sure. And I said, well, my focus is not just to get you the lowest interest rate. My focus is to get you the lowest overall cost of borrowing money. Super, super, super key deal. Because again, remember I told you the first question I get from everybody is, what's your interest rate? Well, in this particular case, the FHA loan was a lower interest rate, but the cost of the FHA loan was considerably more than a conventional loan. So the borrower started talking with me and he said, I don't understand. Why didn't anybody tell me about this other option? And I said, well, it's very clear. They answered the question that you asked. They didn't ask you what you need. So make sure you know who you're working with. Make sure you have the reputation and, this person came from a good referral. They've taken care of people you know. Make sure that you're just not getting on the line and asking for the best rate, because you might get a really low interest rate, but get a really, really wrong loan. Hey, if you have any questions, please don't hesitate to reach out. You've got my information. Look forward to seeing you on the next video.